Hi, welcome back to the channel. Stocks or real estate? Where should you put your money right now? Interest rate moves, sticky mortgage costs, political change in Washington, and regional housing dynamics all matter. And they have shifted in important ways this year. Today I'll walk you through what's actually happening in 2025 and what that means for different people by age, by region, by income level, and job type. By the end, you should have a clearer idea which asset class makes sense for your goals today. Big picture first. In mid-September 2025, the Federal Reserve cut its target range for the federal fund rates to about 4 to 4.25%. But here's the catch. Mortgage rates haven't dropped nearly as much. The average 30-year fixed mortgage rate is still between low to mid 6% range. That keeps monthly payments far above the ultra-low mortgage era we saw just a few years ago. Why the gap? Mortgage rates include a spread above the Fed funds rate, and markets also price in credit risk and mortgage-backed securities. So, even with a Fed cut, buyers still face historically expensive monthly payments. The economy in 2025 is showing a mixed picture. Growth has cooled down since the post-pandemic rebound. Inflation has eased but hasn't completely vanished. And consumers are still managing higher debt loads. That matters for assets. Stocks usually lead the cycle. They fall early when downturns begin and rebound early when growth returns. Real estate reacts more slowly. House prices and construction volumes often lag the cycle by several months. So, if you are a short-term trader who wants to capture rebounds, stocks move faster. If you want slower, steadier exposure with rental income, real estate behaves differently. 2025 is not a federal election year. The next midterms November 2026. But policy still matters. This year, the federal government tightened immigration and visa rules. Enforcement has been more active in certain regions. These decisions directly affect both housing demand and business confidence, even without an election cycle in place. Immigration is a key driver for housing. Newcomers rent apartments, buy starter homes, and boost local services. But in 2025, with tighter immigration rules and stepped up enforcement, the net flow of new residents has slowed compared to the rebound years of COVID. That means in some metro areas, rental demand has cooled. In others, especially high growth regions with strong job markets, demand is still robust, partly due to internal migration. So, immigration's effect on housing is regional, not uniform. As of September 2025, the housing market is uneven. We are seeing a pickup in new home sales and stronger builder confidence in some areas, rising inventory and slower price growth in other areas. Locally in Washington, D.C., DMV region, median home prices have gone up about 4.8% year over year. Median sale price is around $660,000. Some neighborhoods have slight declines, pulling average down to about 3.8%. Bottom line, don't assume a national headline tells this whole story. Local conditions drive outcomes. Real estate is all local. Tech stocks over the last decade. Over the last 10 years, tech giants like Nvidia, AMD, Apple, and Microsoft have delivered exceptional results. Nvidia, for example, has a 10-year annualized return of 70%, fueled by AI and semiconductor demand. The top 7 companies, Apple, Microsoft, Alphabet, Amazon, Meta, Broadcom, Berkshire Hathaway, now make up over 40% of the S&P 500 value, showing how wealth is concentrated in a few mega cap stocks. Historically, top S&P 500 stocks have dominated during bull markets, but concentration at today's level is notable compared to 1990s or 2000 cycle. The Case-Shiller US National Home Price Index is at 331.5 as of June 2025, reflecting modest 1.9% year-over-year growth, showing slow real estate appreciation. Warren Buffett's Berkshire Hathaway holds over $344 billion in cash, showing caution amid high valuations, even as it selectively increases stakes in sectors like healthcare and home building. Tom Lee notes $7 trillion in money market funds could flow, supporting a continued bull market despite high valuations. With low interest rates and limited yield elsewhere, equities remain the main choice for returns, reinforcing the TINA dynamics. There is no alternative dynamics. Bears sound smart by highlighting risks, but historically, bulls make money if invested wisely over time. So advice for small retail investors: diversity across asset classes. Focus on fundamentals and long-term growth. Dollar cost average to reduce timing risk. Balance equities, REITs, real estate investment trusts, and some real estate exposure if possible. Who should prefer stocks versus real estate? Let's do a breakdown by age. If you are in the 20s to early 30s, stocks usually make more sense. Time is on your side for compounding. If you can buy a starter home, great, but equities give flexibility. For someone in the 30s to 40s, a blended approach works best. Growth from stocks, stability from real estate, especially if you are raising a family. For anyone who is 50s and up, real estate helps with rental income and inflation protection. But don't put everything into property. Keep stocks for liquidity in retirement. By reason: high-cost metro areas like DC, entry costs are very high. Many people lean on stocks or REITs for exposure given elevated home values and patchy growth. For Sunbelt areas and lower-cost metros, real estate looks more attractive with stronger rental yields and population growth. But we have to check with local job markets. By education and income. Higher income households often lean more on equities through retirement accounts. Middle income households still see home ownership as a forced savings tool, but high borrowing costs in 2025 raise the entry bar. By job type. Anyone working in tech or commission-based roles, stocks and liquidity are easier to manage, though many buy properties as a hedge. For those who have steady salaried roles like government job, healthcare job, or education sector, it's easier to get mortgage qualification, so real estate is accessible. For entrepreneurs, real estate offers diversification and tax options that fit businesses' risk profiles. Stocks are fast, they are liquid, they are volatile, but good for growth if you can accept swings. For example, S&P 500 has yielded about 11 to 12% year to date, and large cap growth is about 14%. Real estate is slower, costlier to transact, but tangible with rent income and inflation linkage. If you want short-term agility, stocks win. If you want long-term cash flow and stability, real estate still has a place, provided you can handle the upfront cost. Strategy for different goals. Early career, long horizon, prioritize equities and retirement accounts. Add REITs or fractional real estate if you want property exposure. REITs are real estate investment trusts, which gives you exposure to real estate. Cash flow seekers with capital target rental markets with job growth and affordability. Be cautious in markets where demand is cooling. Volatility-averse investors mix rental income, dividend stocks, and growth positions, and keep an emergency fund. Even with a Fed cut, mortgage rates are still historically high. So the decision to buy a home should be about your finances and your local market, not the headline Fed cut. In September 2025, we have a Fed easing slightly. Mortgage rates are still high, immigration is tighter, shaping local demand, and a housing market that varies a lot by region. Which side are you leaning towards right now? Stocks for growth and liquidity, or real estate for income and stability? Tell me your situation in comments, your age, reason, and job, and I'll share what might make sense for you. If you find this helpful, hit like, subscribe, and ring the bell. See you in the next video.